Welcome back to Primary Source China Investment. Peng.guo and I are here with show B3. And what we wanted to discuss is something that we've brought up on the show a lot before in the past. And it is this: China is not only a stock market, but it's also a market of stocks. And what I mean by that is we have to stop looking at the headline names and start looking at broader exposure. Recall, Chinese companies are traded in Shanghai, Shenzhen, Beijing, Hong Kong, and the US. And of course, we've covered this a lot. But for US investors, the most popular news, the news generating stocks, are those Chinese companies listed in the US. And this is a horrible proxy for broad market exposure. The US listed Chinese companies that tend to be newsworthy or followed a lot, get the headlines, are tech forward and newish. These are names like Alibaba, Baidu, Neo, Jingdong, and those dominate. But the largest cap companies on the mainland tend to be industrial, financial, and of course, Baijiu. So we'll put a list of the top 10 names, but you can see industrials, financials, consumer staples. These are the companies that are the largest and profitable companies on the mainland.
That's right. I think from the index design perspective, so it's basically just choose whatever available in the market, and then based on the market cap, that's the primary way to design it. Unfortunately, in the United States, a lot of the high-tech companies, internet-related companies, so they probably get overweight. And the index design and whatever ETF product did not reflect the true situations in the China market. In my opinion, it really should redesign based on whatever available for the sector weight should be consistent or reflect the true situation in the China market. So those kind of the indices or related ETF or index product should follow it. Otherwise, it's easily just concentrate or overbet in one single sector or few sectors. Unfortunately, in China, we know the sector rotation is too quick, like the fan. It's a lot like the clock. So if you're not in the right cycle or something, it's easy to get improper exposure to the China market, and also it's quite misleading.
The index construction that you just mentioned is important because in the US, so many of these ETFs are created out of convenience, not out of investment strategy. So if you look at the two biggest ETFs in the US, MCHI and KWEB, both of them have the same two top holdings. So those companies are put together in an index because they're available, not because they make any investment sense. And those two names, as everybody knows, is Tencent and Alibaba. So index construction is important. And when you flip over to the mainland and Hong Kong, it's very easy to put those large cap companies into an index or other themes because there's many more traded companies. There's somewhat upwards of 7,000 stocks in Shanghai and Shenzhen. The other problem we have on the US side is multiple jurisdictions. There's practical considerations for foreign investors. So currently, the two top securities regulators, the CSRC in China and the SEC in the US, are discussing increasing access to audit results for those US listed Chinese companies. A few of the highest profile names from China listed in the US have already moved or created a second listing in Hong Kong. So Alibaba and Baidu have done that already. So this regulatory discussion has led to massive sell-offs and then rebounds, in a word, volatility. This and other regulatory uncertainty is enough to dissuade investors from allocating to US listed Chinese names. So we'll get into the valuation as well, but there's a lot of things happening with respect to these China companies that are traded in the US.
Yeah, I think that really reflects the regulation or the political fight. It cannot solve the technical problem. It's really like the auditor is really like the technical problem. If they want to work out, they can work out. For example, like the Apple, right? They sell a lot of the data and collect a lot of clients' data in China, but they still work hard with the China government to find the solutions, how to keep the security of the country as well as the leverage, provide the service to the customer. So if that works out for the auditor report, both countries' regulation should have resolved this issue a couple of years ago, rather than make the crisis. This really man-made crisis, make a lot of investors suffer the loss. It doesn't necessary to doing like that. And after the crisis, the both is okay. We get a problem. We need to solve it. Obviously, they should do it much earlier.
This is a problem of a bad decision early on, and then derivative effects later. So, for example, when the first company started, like when Cina listed in the U.S., it was sort of a novelty, and maybe regulators were not that concerned about what the listing, what the audit requirements were going to be, and maybe it was sufficient at that time, and then nothing changed. So fast forward 20 years, now you have over 200 names listed and $1.5 trillion in market value. So what started as something probably benign, again, so we just want to make sure nobody's blaming anybody for how we arrived at this point. It's very obvious how we arrived at this point. Nobody really cared, and then we woke up and we have $1.5 trillion, and the audit function is not the same globally. So we need to harmonize that. So that's how we got here. It's somewhat political, but it's more of a function of, hey, this is how things were done. We just kept doing them. We added 200 names, and now we find ourselves in a regulatory quagmire.
Yeah, that's true. Yeah, so I think if they really want to solve the problem, they can do it. Otherwise, they can keep the problem in there. So,
and it looks like there's going to be a solution. Some of these names are big enough, have no problem with their auditing, have no problem with their numbers, and they're going to stay listed here probably. Yeah. Others, which are smaller, startup in nature, maybe don't have the footing, they may have to delist.
That's true.
Of those, and some of the biggest names may find their way back over to Hong Kong and Shanghai, where they might trade at a higher multiple. So there's going to be a solution. It's just going to, it took 20 years to get here. It can't get worked out in 2 months. So it's going to take some time to work out.
Yeah, that's true. So this really just to classify the different situation. Each situation, they attach the solutions to do that. So theoretically, it's definitely durable things for them, rather than cause the massive problem to all the investors and the big crash in the market. So that's probably that's another opportunities for new investors. So yeah, if you do the deeper analysis, that's a good opportunity to catch a good company.
Yeah, those analysts out there that are telling you they know what's going to happen, they don't. So you need to be very, very careful, and that goes to valuation. So
that's exactly right.
If you look at the Hong Kong and mainland market indices, they trade at a PE of 11.5 and 15.5 respectively. That's pretty good value. The large cap names trade in the US have an average PE of greater than 30, and several of those names are not profitable, implying an infinite PE. Meituan, Kuaishou, these companies are not profitable. So you have the mainland and Hong Kong names that are profitable, large, generating sufficient cash flow, and they trade at a very reasonable PE versus some of the higher flying names, pre-profit companies trading at, well, zero for those, but in aggregate trading at a much higher PE.
Yeah, that's really back to the index design. They should improve their investable universe, not just the US ADR, and as well as should include the Hong Kong as well as Asia market. I know this not fully investable, but whatever, the investable universe need to redefine it. From the company or product perspective, they really need a design, like use a different strategy. For example, like equal weight of the sector or risk parity based on the sector to redesign their own product. If it just simply follow up on the market cap-based stuff, that's easily cause such a problem like that.
Yeah, the investable universe is a problem. Mainland access is still a problem. Hong Kong is overweighted with, real estate and financial services company. There's a lot of problems, and that's why what we're doing here every week is hopefully people are listening and following the advice, learning about this market, which is complex and not getting less complex. It seems to be getting more complex as we roll on.
Yeah, I think everything is pretty much durable as long as it's more like right now the market is not a good index or product proxy the China market. It's really need some customized the benchmark or index for the related product.
Right. I think that's absolutely true, and you have to pick bits and pieces. I constantly go back to this fixed income market, and we talked a couple of weeks ago about how China fixed income is probably a little less attractive given rates in the U.S. have crept up. But in terms of blunting volatility, the fixed income investment is a smart move as well. So it's not, as we've said before, a set it and forget it market. Oh, I just go buy this and I don't have to worry for 5 years. It's not that way at all. You have to be on top of how you're allocating.
That's right. This means it's not easy try to make the money. You have to do some kind of work. If you don't know how to do that, just find the right people, right group to help out.
It's about making money, but it's also about the allocation, right? Just because, the old story was China is not allocated to U.S. market or to European market, and it's a good hedge again. And that's all great. Academically, or that's all great in the model, but practically speaking, how do you execute that? That's efficient. That's on a risk-adjusted basis attractive. That's where the nuance comes in.
That's right. So as soon as we done some of the back testing, mix the equity and the bond. So it looks like if we have the percentage, all choose the uptrend. In the market. So we still need, if we mix the 20 or 30% of the bond, sometimes 40% of bond, the Sharpe ratio is much better. Correct. Than you just hold the equity or just hold the bond. So we really need to get a good Sharpe ratio.
Yeah, we keep talking about it, peng.guo. So hopefully there's listeners out there taking our advice. We're going to leave it with show B3. Thanks for tuning in. We look forward to your comments every week. We're here and we're going to keep putting it out for you.
Thank you.